Hello and welcome to youshallpass.com.
We start by examining the price-yield behavior along the yield spectrum, and we highlight the peculiarities and characteristics of how bond prices behave as the yield changes. We then take a look at how these characteristics are altered, sometimes dramatically, when we look at the price-yield behavior of bonds with put or call options attached compared to option-free bonds. And we then take a look at the concepts of negative convexity and the resultant price compression. Moving on, then, we look at the different approaches to the measurement of interest rate risk, namely the full valuation and the duration convexity approaches. We show how to calculate and use the duration and its shortcomings, and then round off with how to calculate a bond's convexity and use that in tandem with duration to overcome the estimation shortcomings of using duration alone. Alright, so if you're this far into fixed income, by now the relationship between bond prices and interest rates should be second nature to you. As interest rates drop, bond prices come up and vice versa. So the next logical thing to ask then is by how much? And that basically is the measurement of interest rate risk. How much will bond prices rise when interest rates fall by a given amount? And how much will bond prices fall when interest rates rise by a given amount? The change in prices can be measured either as a percentage change or an absolute dollar change. But as we go along, we'll see it's much more useful to look at the price change as a percentage change. So the rest of this video will then focus on how to measure the percentage change in the prices of various bonds in a bond portfolio. The first one is the full valuation approach, which we will look at next. After that, there's the duration and convexity approach, and we will look at that once we're done with the full valuation approach. So, as its name implies, the full valuation approach involves valuing all the bonds in a bond portfolio using a new discount rate. The prices of the individual bonds, the new prices of the individual bonds are then aggregated for the overall new portfolio value. And we can then compare this to the previous portfolio value to determine the percentage change in the value of the portfolio due to a given change in the discount rates. And at its simplest, that really is pretty much all there is to the full valuation approach. We take the existing interest rate, we tag on the number of basis points we want the rate to move up or down, and then use the revised rate to calculate revised prices for all the bonds in our portfolio. The difference then in current and previous portfolio values can be expressed as desired. We did plenty of bond valuation talk and practice in the video about bond valuation. So this video may not be the best place for valuing a portfolio of bonds at various interest rates merely for that purpose. However, this video is in large part about the characteristics of bond prices at various interest rates. So what we'll do is we will construct a hypothetical bond portfolio and value it over a range of interest rates to bring out those characteristics. Our hypothetical portfolio consists of 4 bonds, 2 each of 5 years and 20 years maturity, with coupon rates of 6% and 9% for each pair. These bonds were valued over a range of interest rates from 1% to 10.1%, and a few of those results are presented in this table. The prices over this entire range are then plotted on a curve with the yields on the horizontal axis and the prices on the vertical axis. And the plot looks something like this. Now, the first thing that one can say about the price-yield relationship is that the relationship gets more and more exponential as the time to maturity of the bond increases. And as first impressions go, that is exactly correct. The price yield relationship is inherently exponential, but the exponentialness or the curvature of the price yield curve really starts to become apparent as the coupon rate or the time to maturity of the bond increases. You can see that while bond 1 and bond 2 share the same coupon rate, there's a marked difference in how their curves slope downwards over the yield curve, and the same can be seen for bonds 3 and 4. In the bond world, we have a special name for this curvature, this exponentialness, and that special name is convexity. The greater the curve a bond has, then all else being equal, the greater its convexity. This is the foremost thing to understand about the price yield relationship for fixed coupon bonds, that their price yield curves have a convex shape, and the convexity is greater the greater a bond's coupon or its time to maturity. So, what does this convexity, this shape on the price yield curve, really mean? Uh, it largely means that the percentage change in price for a given basis points change in yield, it won't be the same across the yield curve and for all bonds. For instance, as you can see for bond 4, there's a much steeper rise in price when yields shift from 1.7 to 1% than when yields shift from 9.4 to 8.7%. We've chosen bond 4 to bring this out because the convex shape is the most accentuated here. And although the convexity may not be as apparent or as exaggerated for the other bonds, believe me, it's there and it's real for all bonds here and generally for all bonds. To summarize then, the extent of change in bond price for a given change in yield depends on two things. The first one being that where along the yield curve do you stand at present, and secondly, how steep is the slope of the price yield curve between the initial and the final interest rates. These are two important observations, so you should treat them as such, meaning write them down somewhere and remember them along with pretty much the entire material here in this video. There's another, perhaps equally important characteristic about bond price behavior that one can observe from the curves above. If you look at the curves, they obviously slope from left to right, which means that any reduction in yield will result in a leftward movement along the price yield curve, and any increase in yield will lead to a rightward movement. Looking at the shape of the curves then, specifically the one for bond 4 where the curvature is the most accentuated, you can see that as we move leftward along the yield curve, the changes in price become greater for a given change in yield. And as we move rightward, the opposite applies. That is, for any rightward movement along this curve, the changes in price become smaller for a given change in yield. Now, look at the point where the yield is 1.7%. The price at that point is a little under $225 per $100 of face value. If the yield were to drop by 70 basis points, the resultant change in price is visibly greater than if the yield were to rise by 70 basis. To be more precise, as can be seen from this price table, the price changes by more than 9.5% when yields drop by 70 basis, but fall only by 8.5% when yields rise by 70 basis. And that leads us to a third important observation into bond price behavior, that just due to the convex shape of the price yield curve, all rightward movements will be accompanied by smaller price changes than for leftward movements. In other words, for a given change in yield, the absolute quantum of the percentage price increase will be greater than the absolute percentage price decrease. To recap, here we summarize the key observations that we've picked up so far. That the extent of change in a bond's price depends on the current interest rate, and also on the steepness of the slope of the price yield curve between the initial and the final interest rates. And also, the direction of the interest rate change matters. That is, a decrease in yield will bring about a larger absolute percentage change in price than will an increase. You will appreciate that all three of these characteristics of price yield behavior are largely due to the convex shape of the price yield curve. To the extent, in fact, that if the convexity were to be removed, if the relationship were to become linear, then the first and the third of these characteristics would also not be observed. Um, then, to these three, then we add a fourth and perhaps less obvious characteristic. That one being that if the change in yield in question is small, that is small enough to not bring the shape of the curve in play, then the percentage price change for a given bond will be approximately equal regardless of whether the yield is increasing or decreasing. Small obviously meaning the number of basis points small enough that the steepness of the curve in either direction remains approximately the same between the initial and the final yields. All right, so these four characteristics of how bond prices behave as yield changes can be observed from the foregoing discussion. There are only four, so like few in number but high in significance. So it's important that you know them, you understand how they arise, and you remember them. And also, very importantly, you must remember that they pertain only to fixed coupon option free bonds. For bonds with put or call options, we'll soon find out that the story is roughly the same, but not exactly. But before we start talking about the price yield behavior of bonds with attached options, let's recap a little about what put and call options are and how they affect bond cash flows. Let's start with put options. These give investors the right to sell the bond back to the issuer at a predetermined price, regardless of the prevailing market price. It's not an obligation, but it's a right. So the investor has a choice. If, for instance, if the bond can be sold back to the issuer at par or 100 cents to the dollar, the investor will hang on to the bond as long as the market price of the bond does not fall below 100. If, however, interest rates rise or the credit rating of the issuer declines, the price of the bond will decline. And as soon as it goes below 100 and looks like it's going to stay below 100, the investor will exercise her put option and put or sell the bond back to the issuer. The price of par or whatever price is determined at the outset to put the bond back to the issuer is known as the strike or the exercise price of the option. On the other hand, call options provide issuers with the right, but not the obligation, to buy the bond back from investors at a predetermined price, regardless of prevailing market prices. So, as long as the market price is lower than the exercise price, call options will remain unexercised. But if interest rates decline or the credit rating of the issuer improves, it will become cheaper for the issuer to borrow funds. The improvement in business conditions will start to reflect in improved prices for the company's bonds, and as soon as those prices climb sustainably above the exercise price or the strike price of the call option, it will make financial sense for the issuer to call or to buy back the bonds and reissue another bond at a cheaper interest rate. If, on the flip side, interest rates rise or the creditworthiness of the issuer worsens, as we just mentioned a few minutes ago, this will start to reflect in the price of the bonds, and if the price goes below the strike price of the put option and looks like it's going to stay below that price, the investor will exercise her put option and put or sell the bond back to the issuer at the put price, which is usually par value. For a fuller, more complete discussion on put and call options, We do that in our video about option adjusted spreads for bonds. So you can check that out too if you haven't already. Reverting back to call options then, it's reasonable to assume that as interest rates decline, then the likelihood of the call option being exercised increases. And by the same point, as the likelihood of the call option being exercised increases, the price of the bond starts to tend closer and closer to the call price, regardless of what the interest rates are. The lower the interest rate, the greater the likelihood of the call being exercised, and the closer the price will be to the call price. Here we have the normal convex curve for an option-free bond. Where a bond with a call option differs is that as the interest rates go below a certain threshold, and in case of the call price being par, that interest rate threshold is usually the coupon rate. So as interest rates reduce below that threshold, the increase in price starts to flatten out. As we can see, the curve starts to branch out. And the intuitive reasoning for this phenomenon is simply that since the investors know that the bond is now likely to be called at the call price, then regardless of what interest rates are, the price will never stray too far from the call price, because investors know that the call price is the most that they will get for their investment. So no investor will be willing to bid too far from the call price. For instance, if say the justified price based on low interest rates for an option-free bond was $105 for a par value of $100, even in that case, for an investor, the most callable bond would be worth is $100, because it doesn't really make financial sense to buy something for $105 only to have it called or bought back by the company for $100. So, just to provide some intuitive and common sense reasoning behind this flattening out of the price yield curve, it is simply that a callable bond will be, once it is in the zone, in the interest rate zone where it's likely to be called, the most a callable bond will be worth is at or very close to its call price. This branching out of the price yield curve, this is called the zone of negative convexity, and one simple reason for that is that you can see that the shapes of the curves have become opposite, and in the negative convexity zone we have what is known as price compression. That is, regardless of how low interest rates have gone, there is little, if any, upward movement in price, and the intuitive investment reasoning for that I've already laid out. In the case of put options, where the investor has the right to put or sell the bond back to the issuer at a certain price, there the sequence of events and the logical reasoning is turned on its head compared to callable bonds. Over here, what happens is that as interest rates start to move above a certain threshold, the bond starts to lose value and go down in price. But then what happens is that as the bond starts to go down in price, the likelihood of the put being exercised starts to go up. And as the likelihood of the put being exercised starts to go up, then the price tends to stay closer and closer to the put price. So even where interest rates have risen substantially beyond the coupon rate, even then the bond price will keep dithering around the put price. Hence, this branching or forking out, where the downward slope of the curve has flattened out. Reason obviously being that as compared to an option-free bond, investors of a bond with a put option, they have the option to sell the bond back to the issuer at a certain price, regardless of what market prices are. And that serves to put a floor of sorts under the price of the bond. Again, with regard to the pricing of bonds with call or put options, we've covered this subject much more comprehensively in a video on option adjusted spreads for bonds. So you might like to check that out if you haven't already. We've explained the steps involved then in the valuation of fixed coupon bonds, both with and without options. These steps will need to be followed if you're following the full valuation approach, but it's certainly not something that we recommend. Not least, in fact, because Maximus said so.
You find yourself alone, riding in green fields with the sun on your face. Do not be troubled, for you are in Elysium, and you're already dead!
Well, he might as well have been talking about the full valuation approach. If you find yourself not pressed for time and leisurely running a full valuation on a bond portfolio, do not be troubled, for your fund has blown up and you're already out of a job. Seriously speaking though, in most investment work it's far better to be quick and fairly accurate rather than extremely precise and painstakingly slow. For a bond portfolio with a large number of bonds, the full valuation approach will likely take up a lot of time. And a lot of the time, fund managers just don't have a lot of time to figure out how their portfolio will react as yields change. If something like the Greek crisis, for instance, had sent the yields skyrocketing, you as a fund manager or the fund's analyst, you need to know now how much you stand to lose on a long position or gain on a short. And you have seconds to figure it out, not hours. Therefore, with considerations of time in mind, a measure was developed to provide an instant and fairly accurate idea of how one bond or a bond portfolio's value will change when yields change. That measure is called duration. Duration is denominated in years and it works as follows. If a bond's duration is say 4.5 years, it means that the bond price will change by 4.5% if yields change either way by 100 basis points. And by extension, if a portfolio has an average duration of 4.5 years, it means that the portfolio value will change by 4.5% if yields change by 100 basis points, even though some of the bonds in the portfolio will change by a smaller or a larger percentage. All bonds are born with a duration, and the duration changes as the bond's age and its YTM change. The formula for duration, how to calculate it, is shown here, and we also know how to calculate duration in practice. For example, reverting back to the 20-year 9% coupon bond we based much of our earlier material on, the price of the bond at a 6.6% yield level is 126.4404. If we were to shock the yield up by 20 basis points to 6.8%, the price would be 123.8593, and for a 20 basis shock down, the revised price at a 6.4% yield level is 129.1009. So we simply plug these numbers into the formula above, and our duration for this bond at the 6.6% yield level works out to 10.36 years. The next question then is, what does this 10.36 mean? And what it means is that the price of a bond with 20 years remaining in its life and 9% coupon rate, which is currently trading at 6.6%, will change by approximately 10.36% if yields change by 100 basis points either way. One more critical thing, which is also a fairly simple one, needs to be brought out here. And that is that since duration measures the sensitivity of bond price to changes in yield, then it should properly also reflect the changing sensitivity as the yield level changes. As we saw earlier, where the price sensitivity was much higher at lower yield levels. Happily, we can show here that this is true, and that duration calculated as per the formula does change with yield and does reflect the changing sensitivity of bond prices as yields change. As you can see, for a 5.6% difference in starting yield, the difference in duration is nearly 30%. That is that the duration when the starting point is lower is around 30% higher for a 5.6% difference in the starting levels of yield, and the difference in duration would have been even more pronounced had the difference in starting yields been even higher. So then duration can be a very useful snapshot measure of the interest rate sensitivity of a bond or a portfolio of bonds. However, it suffers from the drawback that it is calculated assuming symmetrical price movements around a particular yield, even when we know that it isn't so. Generally, bond prices fall by less than they rise for a given change in yield. However, as we'll show here, duration is still a pretty good approximation to the exact price movements for small changes in yield. For example, consider the table above. We use the same 20-year 9% bond that we've been using so far, and we show the exact prices for this bond at 6.6%, 6.8%, and 6.4%. We then prorate the duration of 10.36 years for the actual change in yield, that is 20 basis. So the actual percentage price change then works out to slightly over 2%. This 2% then is how much prices should increase or decrease by for a 20 basis change in yield, as calculated by the duration measure. And as we can see from our workings, it's a pretty good approximation. There's a little difference between the exact between the percentage changes in price based on the exact prices and the percentage change in price as approximated by multiplying duration with the initial price and then prorating it for the actual change in yield. So we can say that here, for a 20 basis change in yield, duration's done a pretty good job of estimating the percentage change that will occur in the bond's price. Let's look at some other changes in yield to assess how resilient is the accuracy of the duration measure. Alright, here we do the same thing as we did in the previous slide, but we do it on a bigger scale. Instead of the 20 basis change in yield, we're now talking about a 200 basis change in yield, and as you can see, the difference in the results from actual to approximate has grown quite a bit. It's now almost 3.5% for the 200 basis shock up and almost 3% for the 200 basis rate shock down. And while the actual numbers don't mean much, the point we're trying to highlight is that even as far as bond duration goes, size does matter. And due to the assumption of symmetrical price movements around a given initial yield, the inaccuracy in estimating prices using duration grows as the size of the rate shock being modeled grows. We just showed that for small changes in yield, duration is a pretty good measure of estimating price movements, but for larger rate shocks, not so much. Um, Now for some bad news. The duration that we've been talking about so far is actually one of a few types of duration. And if you're down for some hair splitting, it's actually called the effective duration because by comparing actual and exact prices, both post and pre yield change, it takes into account the effective cash flows, including those which are altered due to the exercise of the option. So, what we've been talking about so far is effective duration. There's another type of duration measure which is known as the modified duration, and it's known as that because it doesn't take into account the alteration of cash flows but instead assumes that all bonds are option free, even those which are not. The duration thus calculated is obviously identical to effective duration for bonds that are option free, but for bonds with options, depending on prevailing interest rates and how likely the exercise of either the put or the call option is, the difference between effective and modified duration can be substantial, sometimes even dramatic. There's a third type of duration known as the Macaulay duration, and it looks something like this. The Macaulay duration was developed by a guy named Macaulay, who I guess found himself with a bit of time on his hands back in 1938. Rumor has it that he carried aspirations of becoming an actuary, and while it's not known whether he did actually become one, he certainly did carry the traits of being one, namely by coming up with difficult ways of expressing simple things, which in the end turned out to be both not exactly useful and quite redundant. The central idea or the theme underlying the Macaulay duration is that it's the present value weighted average of the times at which cash flows occur during the bond's life. And as such, it's conceptually quite close to the weighted average time to maturity. Um, the Macaulay duration is related to the modified duration by this formula, and while it's unlikely that you'll be called upon to actually calculate the Macaulay duration in an exam, um, it is useful to sort of understand the conceptual underpinnings of it, and also to know this formula because you may be required to convert either from the modified to the Macaulay or vice versa. Moving on to more useful things, let's talk about how to calculate the portfolio duration for a portfolio of bonds. The idea here obviously being that to be able to get to a quick and fairly accurate idea of how the value of a portfolio will change, it turns out it's fairly simple and intuitive. The portfolio duration is simply the weighted average of the durations of all the individual bonds in the portfolio. And the weights being used are the market value of each bond relative to the aggregate market value of the portfolio. Expressed mathematically, it looks something like this. And by way of a worked example, we have the this table where we have three bonds with market values of 1.5 million, 2.5 million, and $675,000 each. The duration for each bond is 3.75 years, 8.25 years, and 13.5 years. And as you can see, we've worked out the weights of each bond's market value relative to the total market value, and then weighted the duration by the respective weights. You sum up the weighted average durations, and you get the weighted average duration of the portfolio. In this case, it's slightly above 7.5 years. We've spoken at length now of duration, And before closing, I guess it's good to just go back to basics and remember that duration is expressed in years, but what it actually represents is the percentage change in price per 100 basis change in yield either way. The way to use duration is to work out the approximate percentage change in price for a given change in yield. And you do that by taking the negative of the duration, multiplying that by the actual decimal change in yield for which you're trying to calculate the approximate change in price, and then multiplying that by 100. What you get then is the approximate percentage change in price for the specific change in yield that you are trying to consider. As we'd said earlier, the duration measure, owing to its assumption of symmetrical price changes, it starts to get more and more inaccurate as the quantum of the yield change increases. A way to compensate for this inaccuracy is by using the convexity adjustment. The formula for convexity is shown here, and this is an important formula and you should learn this. There's a potential stumbling block that you need to be aware of at this point. That is the difference between the delta y used in the convexity adjustment and the delta I that is used while calculating convexity. Delta I here, the one that's used in the convexity formula, is the reference change in yield. It's the change in yield which is then used to calculate the price of the bond when yields rise by delta I and also when yields decline by delta I. So in that sense, it's pretty much similar to the change in yield which is used to calculate duration. The delta y, the one used in the convexity adjustment, is the actual change in yield for which you're trying to get a price approximation for. In that sense, it's also then analogous to the change in yield while calculating the approximate price impact using duration. In both cases, you have a reference change in yield with which you've calculated the duration or the convexity. That's the delta I. And then you have your delta y, which is the actual change in yield, to which you then multiply the convexity or the duration, and then you get the approximate change in price. I think we'll do better if we skip the words and go directly to the numbers here. So we have the convexity adjustment formula, but first we need to go about calculating convexity itself, and we show the exact prices for the initial yield and the 20 basis changes in yield which we had used earlier, and we plug these values in to calculate the exact convexity, which works out to close to 78.5. Now we go about calculating the convexity adjustment for an actual rate shock of 200 basis. Keep in mind that the convexity was calculated using a 20 basis change in yield, so that would be your delta I. And now for your delta y, that is the actual rate shock, we've got 200 basis, and substituting that, the decimal value for that in the convexity adjustment formula, the convexity adjustment works out to 3.14%. Here we show how to use the convexity adjustment in tandem with duration to come up with a better price approximation for a given large change in yield than just using duration alone. In the second column, we have the exact changes in prices, and in the third column, we have the change in prices as given by duration alone. And as you can see, the difference is about 3.5%. In the fourth column, we add the convexity adjustment, that being 3.14%, which we had earlier shown, and we add that to the duration. And as you can see, the results then approximate the exact results much better. So it's fair to say that for large changes in yield, where duration isn't doing a great job of estimating the price, the price change, it's better to use duration and convexity. The convexity adjustment is useful in that not only does it help to arrive at a better approximation of price change than by using duration alone, because the convexity adjustment helps to account for the curvature or convexity of the price yield curve, but the convexity measure also automatically adjusts for the positive or negative convexity zones exhibited by a callable bond. That is that when the prices are in the positive convexity zone, the convexity adjustment formula yields a positive figure, and a negative figure when the prices are in the negative convexity zone. In either case, similar to the calculation done above, the convexity adjustment needs to be added to the price change as per the duration to arrive at the revised price approximation. All right, so much for the measurement of interest rate risk. We've shown the full valuation approach and the duration approaches to measuring changes in portfolio or bond values as yields change. We've highlighted the shortcomings of both, and we've touched upon the various sorts of duration measures. We've also shown how to apply the convexity adjustment to arrive at better price approximation than using duration alone. Now it's time for you to look at the chapter summary at the end of the curriculum readings, and it shouldn't seem all that arcane and alien now. And you should be familiar with the ideas mentioned in there. Try the practice questions. Those should be fairly doable as well. Have faith, practice, and you shall pass.